You're now listening to the Supply Chain Secrets Podcast, the ultimate insider's guide for all things ocean shipping. Brought to you by Kaishax, helping you deliver through volatility.
Hi, everyone. You're listening to the Supply Chain Secrets Podcast. I'm your co-host, Caroline Weaver, and with me is Lars Jensen. Lars, how are you doing?
Doing great, thanks. Over on the lovely island of Funen in Denmark today.
Amazing. Cold there or sunny, balmy? What's it feeling like over there?
Not sunny, not balmy, cold and wind, but compared to where we were in Denmark a month ago, this is early spring.
That's good. Awesome. And today we also have a special guest with us. So we have Peter Stallion from Clarksons. Peter, could you introduce yourself to the listeners?
Thank you very much. My name is Peter. I run container futures here at Clarksons. We're a global ship broker and futures broking company. I wish I was on an island, the same as Lars, but I'm in London in our HQ. Although I think the weather's going to be a lot better than it is on your island. I don't know what the Fahrenheit is, but I think we're forecast for 19 degrees, which is very strange for London midweek. So, well, there we go. I wish I was on that island. Clarksons is part of a regulated company, and as part of our podcast appearance, I do have to read a disclaimer from my side. So bear with me, because I think it's the first time I've ever read this entirely in my life. So here we go. So Clarksons Futures Limited is authorized and regulated by the UK FCA and registered with the US NFA as an introducing broker. We are subject to regulations regarding financial promotions, including NFA Rule 229 and Rule 29. Our views are for general guidance only and not to be construed as investment, tax, or legal advice. We are not soliciting any action based upon our views.
All right. So Lars, why don't we talk about what's driving the market right now?
I think there's one key thing that's driving the market that's on everybody's mind as well. That's, of course, the continuing crisis in the Hormuz. As a quick rundown on where we are, if anything, compared to when we spoke a week ago, things have just gotten worse. When we spoke a week ago, we had one container vessel that got hit. During the past week, another two got hit. And more disconcertingly, the two vessels that got hit were not trying to cross the Strait of Hormuz. They were sitting at anchor off of basically the coast of Dubai. One of these was from O&E, the other one was Maersk and Hapag, one of their shuttle ships. Fortunately, no major damage, nobody got hurt. On top of that, there were multiple tanker vessels that also got hit in the past week. So compared to a week ago, things are getting worse. Slight improvement in terms of who else could get through. India, just a couple of days, made it official they had two tankers that went through due to an agreement between the Indian Foreign Ministry and Iran. We also every morning here see multiple vessels, but they come specifically from Iranian ports. So looking at this specifically from a container shipping perspective, the strait is closed. We also see impact elsewhere, because one thing is we say, fine, then we can stay outside and offload cargo, but attacks from the Iranians over the past few days have seen them not just targeting, but also hitting fuel facilities outside the ports, both of Fujairah and Salalah, which at times does lead to suspended operations for container shipping as well, which inevitably is going to lead to more delays in vessels, more backup of containers, and thereby also increased upwards pressure on the freight rates. So I personally don't see any indication of any type of normalization right now, and it doesn't appear that it's right around the corner. And more carriers seem to come to that conclusion. Let's take one example. I was looking at, again, the S trackers and vessels this morning. COSCO had their 19,000 TEU vessel, CSCL Globe. It had been sitting at the mouth of the Strait of Hormuz trying to get in for the last 2 weeks, awaiting the situation. Apparently the Chinese have now also given up, and this vessel is now steaming back to Singapore, where it came from. And I think this is a very good cue that even the largest container lines, even the Chinese, don't believe there is a short-term solution to the current problem. If we try to look at what this means in terms of the spot rates, if we're looking at the NIFI, we don't see any material impact as of yet, because a lot of these announcements that have come out, of course, takes time to get implemented. They are not reflected there yet. The one where we have seen a massive impact already is, absolutely not surprisingly, the SCFI from Shanghai to Dubai. It's up by about $2,000 per 20-foot just over the past 2 weeks. But of course, given how rapidly this situation is unfolding, these changes that are now making their ways into all the spot rates are not quite reflected in the indices yet. It's a reflection of what happens now, What happens further down the line? I'm going to leave this one as a slight teaser because Peter's going to talk a bit more about that once I'm done going through what we see in the market. But to give some sort of idea of the magnitude of the increases that are coming out there, apart from the specific emergency surcharge related to Gulf and Red Sea ports, where carriers are happily announcing $3,000-$4,000 increases, we're seeing many other trades that are not directly touching the Gulf announce anywhere between $500 and $2,000 per FFE increases as well. This is not the same that they will necessarily be fully successful with all of these, but it is definitely coming. One element that's also coming are increases in bunker fuel surcharges. The bunker price continues upwards. Again, no surprise there. If you look at the normal heavy fuel, it is now, if we measure as the global average, it's at the highest level ever. For low sulfur fuel, it's not quite record level, but that's only because there was a tiny period after the Russian invasion of Ukraine where low sulfur fuel spiked to an even higher level than what it was at least here prior to the weekend. But if the Hormuz continues, we're likely going to break that record too. It has led carriers to announce emergency fuel surcharges. We should be careful here because anyone that has variable bunker surcharges inevitably will pay for this through those. It's just a matter of timing. The increases we see in bunker fuel now will be reflected in bunker surcharges in Q3. It's just a timing issue. So when carriers are now coming out with emergency fuel surcharges, if you already have a variable surcharge, to some degree, you might end up paying double. If you have anything with fixed surcharges, you're likely going to be having to pay this. The same thing goes for spots. So that is basically the main part of what is driving the market. Before handing it over to Peter to give us some idea of what could potentially also be done in dealing with this, I want to touch on two other issues that otherwise tends to drown in the whole chaos around the Hormuz. One thing is the tariffs. The tariffs have completely left the headlines because everybody's now talking the Middle East war. But it should be noted that over the past week, the U.S. have initiated dozens of Section 301 investigations. These are basically groundwork being laid to make tariffs on the basis of Section 301 later in 2026. So even though we know the new 15% tariffs only run for 150 days, these investigations are paving the way to then make them a lot more permanent when we come to summer 2026. So tariffs are by no means gone at all. And the last one I want to bring to everybody's attention is what I would call the more slow cooking problem over in Panama. We have touched upon it before, where, as I think everybody remembers, a bit over a year ago, the U.S. wanted control over the Panama Canal, claiming it to be Chinese influenced. Then we had the whole debacle. Could Hutchison sell the terminals? They thought they could, then they couldn't. Then you can either say that there was a ruling in Panama from the Supreme Court that the tender was given on an illegal basis, stripping Hutchison from them. I think the Chinese perspective is this was an illegal nationalization. There are different ways of viewing this. De facto is Hutchison is out of Panama. APMT and MSC has taken over for an interim period. Panama is likely then at least on the good side with the U.S. The problem is China has already threatened retaliation on Panama. And that's why I call it a slow cooking problem. We already had about a week ago MSC and Maersk being called in for talks with the Ministry of Transportation. There's absolutely zero information what those talks were about. I fail to see that it could be likely anything other than the Panama issue, because it was any other market-related issues, you would have seen the other major carriers called in as well. And the latest development here is COSCO has now stopped calling the terminal in Balboa. It was one of the terminals that used to be operated by Hutchison. Now it's been taken over by APMT, and COSCO has simply pulled out. So there's not an immediate and urgent fire in Panama, but what I see here are the makings of a continuing geopolitical strife, specifically between US and China over access to the Panama Canal. So we have not heard the last of this story. These are only the opening acts.
Gosh. Okay. So volatility is continuing. It looks especially troublesome when you think of all the different variables at play here. It's always been volatile in the ocean freight market. So maybe, Peter, I want to pass it over to you and talk about why is hedging becoming such an important topic? And maybe even before that, what is hedging? If we want to give our listeners a good baseline here.
Yeah, sure. Thank you. Thank you, Lars. That was a really good summary of pretty much everything that's going on. I think a lot of people, including you, Lars, were saying at the start of this year, 2026 is going to be the year of volatility, because that's kind of how it happened over the past 4 years. And it hasn't failed to disappoint in terms of what's happened already this year. Tariffs and then wars and then everything else you have to do with Panama and everything else. But essentially, the hedging topic is all about providing a tool. Again, going back to Lars, you said it best, a tool in the contracting toolbox, where you are providing a means for shipper, carrier, freight forwarder, whoever, to lock in a rate at any future time against the benchmark. So we have the NIFI here, so it might be the NIFI Asia US West Coast benchmark. To lock in a price in advance up to 2, 3, 4 years and have that price honored to have it perform at that price. The reason why we are very, very keen on promoting this market within the physical container freight world is you're moving away from this idea of an annual contract cycle, or you say, well, we're going to agree a price, we're going to negotiate and agree a price. It's going to take months to negotiate that price. If we manage to actually fix a price, at any point during the course of that contract, you may run into operational issues because of some kind of, crunch in demand or supply or some kind of geopolitical event. You may have some kind of negative impact from bunker adjustment factor. So we've seen that recently, where you see massive increases in BAF. That all impacts the price you actually pay as a BCO, as a shipper, as a freight forwarder. It also impacts how much you're spending to consume fuel as a carrier. All these different variables tend to buffet around the rate in a normal time frame, and in exceptional circumstances, you start to see contracts fail. We've seen that many, many times over the past 4 years on both sides of the market, both on the carrier side and on the BCO side, depending on which way the market is moving usually. Futures are a tool to essentially get rid of that problem, is to have a price that you can rely on, regardless of whether that benchmark moves, 50, 100, 500, 1,000%. It doesn't matter. The enforceability is there. That really blends into this big shift, as maybe something that will be touched on later, into index-linked contracting, which is why we start to see, uptake of indexes such as NIFI and a really positive attitude towards this whole market. When you're combining essentially an index-linked contract, which is in place to deliver on contract operations or contract security, so you're always paying the most efficient or close to the most efficient price in the market at any point in time, so you're more likely to get lifted onto a vessel, you're more likely to have your contract stand. That fixes a lot of the operational contractual issues, but then it exposes you to price fluctuations. When you marry the index-linked contract to a futures contract, all of a sudden you've got a fixed price and you've got better contract security with the index-linked contract. And it's not really, us saying this to the market anymore. Certainly when we started looking at this, Clarksons have been involved way back in 2010, 2011, when there was the first ever freight futures. I'd been doing this for about 5.5, 6 years. When we first started doing this, index linking was a known thing, various levels of uptake from various people and various trades. That's grown, and that has really unlocked, what with contract failures in 22, 23, 24, it's unlocked a lot of interest in futures contracts because it's provable that it actually locks in prices when you actually have this tool in place. That's the overview. In terms of how it actually works, that's where you need to sort of get into a more direct conversation with either me or NICEX or whoever, because you're essentially dealing with a financial contract that sits on top of whatever you're doing in the physical world. And all it's doing is offsetting that physical movement. If you've bought something or you're buying something in the future from container lines, you are presumably hoping that container price either drops or stays flat. Volatility means that probably isn't going to be the case. It might be, who knows? It may be up, down, flat. You don't know what's going to happen in the future. You are literally buying a future when you cover that period that you need to lift containers from whatever period or whatever route you want to do. And all it's doing is offsetting the price increase should that price increase, and also offsetting if that price falls. The result is you have a fixed price in the middle that does not damage relationships with carriers, with freight forwarders. There's no sort of commitment issue in terms of the pricing on your side of the agreement. that all runs in the background, and your physical side of the business now focuses on service and contract performance rather than negotiating and renegotiating pricing, which is often the pain point in something like an annual contract. And even if you fix an annual contract for this year, if you're on the Trans-Pacific trade, you maybe want to fix it next month, but when we hear these contracts are being pushed back and back and back with what's happening in the market, but let's say you do, even if you have that annual contract and there's performance of it, next year, your annual contract price is going to change based on what that market has just done in the previous year and what the sentiment's going to be in the future. So you're kind of already riding that spot market to some degree because it's going to influence your annual contract price. So it's not an alien idea, and it is seeing significant uptake from across the market, especially Transpac, which is almost a new thing. It was very much Asia, Europe that was doing lots of index-linked contracts, less so the Trans-Pacific.
That makes sense. In your opinion, why do you think there's been hesitation around hedging ocean freight in the past? And what do you think has changed that?
I mean, initially, I'm thinking way back in 2010, the whole issue was you had a reasonably new index, SCFI. This is all post-financial crash, so you had some skepticism as to how futures work and financial markets work. You have skepticism from the ocean liners. Essentially, they've been told by the Chinese government, you must submit to this SCFI, otherwise you can't call up Chinese ports. So they've got an index that's just been created. You've shifted over from a system where pretty much rates were agreed on a biannual basis to an index, very, very transparent system. It's taken years for that index to be fully adopted, or indexation generally to be fully adopted. It's pretty prevalent now across the entire market. So you had the index piece is very, very comfortable. And in terms of the futures piece, when we started looking at this, it wasn't that people didn't see the value. Even the carriers were very, very enthusiastic on the principle to say, look, we can offer you something that, offer you a market that can give you long-term security, because that's very important from an ocean liner's perspective, because they have assets they need to fund, they have decarbonization they had to fund, they have vast employee bases, they've got a huge amount of cash flow they need to cover via some means of hedging. But like a lot of things in the freight world, taken a while to actually ingratiate itself in the market. And I think the big change over the past year or so has been, firstly, quite public adoption by ocean liners, quite public adoption by big freight forwarders and by BCOs. So that's helped sort of develop the topic. And then very recently, we saw an explosion in volume just driven by, well, we have everything in place now. We did when we started, but the counterparties are there, the clients are there, ready to actually take on these futures contracts. All of a sudden, an event happens in Iran. Everyone's got access to the mechanism. The volumes shoot up, uptake shoots up, and then volume sort of begets volume as you grow these markets. So that's somewhat the answer as to why it's happening now rather than 5, 10, 15 years ago.
Yeah.
Maybe if I can throw in another reason why it might be happening now and not back then. Yeah, we've always had volatility, but the absolute magnitude of the volatility these last 6 years is completely different. If we go back to, you were mentioning way back when the SCFI got started, I just looked it up here. I mean, from the bottom during the financial crisis, and then we had this massive spike in rates in the Pacific when the markets came back. Rates in the Pacific increased $2,000 per FFE over a year. Now we have seen the same kind of increase in a matter of a couple of weeks into the Middle East. And over the last 6 years, an increase of $2,000 over a few weeks has become fairly regular occurrences. So the sheer magnitude of the exposure is many, many times larger than it was back then 15 years ago.
That's a really good point. And I think when you look at the traditional model, you have your negotiation season that is now starting earlier and earlier, especially if you're looking at TPEB. So you're spending all of those months ahead of your May 1st start date. But now, as you're saying, like these rates are changing so dramatically, so quickly that you're spending a lot of time reworking things and having these conversations over and over again. Think of all the things you could be doing, all the other initiatives that you could be looking into and working on to help with your department. So it's an interesting thing to think about. And Peter, maybe a question for you. So If I'm on a procurement team at a BCO or an NVO, how should I be thinking about hedging within the broader context of freight strategy? Is it mainly reducing risk? Is it about strategic advantages?
Well, I think it depends on the character of your business is the best way to put it. Ultimately, hedging tools are there to reduce risk. A physical buyer, if you're a BCO, you don't necessarily care too much about what the price is. You have a budget in mind. You have to prove that you're within the market sort of parameters, whatever the market might be. But the ultimate goal is to fix a price, is to fix that budget, because your business is not container freight. Usually, if you're a BCO, your business is, production of some kind of item, delivery of some kind of product, commodity, whatever it is. And if the freight market balloons or the freight market price fails in your contracting, then all of a sudden your margins on your overall business get wiped out. And that's when you'll get the CFO knocking at the ocean procurement door saying, what's going on in the ocean freight market? You just evaporated our operating margin for this particular product that we're importing. So that's the ultimate goal from a BCO standpoint. But then ultimately, and this bleeds into the side of the freight forwarders, if you are in a position where you've locked a price for our futures, the market goes up, you've got a guaranteed price for that futures contract, you are in a position to say, well, hang on a minute, I've already locked in my price 6 months ago, and this market has just shot up. Most of my competitors haven't engaged in futures trading or futures hedging. You can outcompete your competitors in this kind of environment. That will maybe be the case for the BCO side of the market, especially if you're very, very focused on container freight, or if you're on very sort of low value, low margin goods that move in containers. You could essentially say, well, we can either outcompete because our freight spend is more reliable. We can forecast it better. And then there's also a bit of an impact in the general financials of a business. If you're publicly traded, if you're traded on the NASDAQ or the NYC or the FTSE or wherever it might be, and you can say, well, this very, very volatile logistics spend, we've been able to lock it in for 2 years. And by the way, it's a futures contract that is honorable. It's not going to go away if the market moves. That's going to have an impact on things like share price, things like financing. So it's really quite widespread. But ultimately, the goal is to lock in that price, whatever you need to secure that budget and hedge your cash flows.
So could you give an example, like if you're just starting to dip your toe in the water here, what does a typical first hedge look like? How basic, how minimum can we get here to just get a feel for how it works?
The good thing about futures contracts, we'll refer to the ICE launch on the 7th of April, which is the NYFI contract that's coming out. The minimum trade size is 10 lots, which is 10 FEUs, 40-foot containers essentially, per month. So you could start with 10. It doesn't really matter. And then you can scale it as you need to. The challenge, I think, for a lot of businesses is the theory and the concept is usually understood very, very quickly, which again is another big change from 5, 10, 15 years ago. But then you have to go through things like onboarding with brokers such as Clarksons, where we can actually facilitate the market. There's onboarding with clearing firms. That can be time consuming. Once you have all that process set up, it's going to be a matter of saying, as a BCO, firstly, I want to try this out against a small portion of my business to actually see how it works in practice. So you say, well, here's the bit of business I want to cover for my Asia, US, West Coast trade. I'm going to buy something nearby. I'm going to buy, let's say, May 2026. You'll come to us and say, and this bleeds into something else we're going to talk about. Come to us and say, where's the forward curve being priced at? Where are you marking this forward price? We'll say it's at X amount, dollar value. You say, yeah, I'm happy with that price. Let's buy 10 containers at whatever value for May 26 on Asia, US West Coast. That's the trade done. That's the trade essentially locked in. We'll do that trade on exchange for you. It's called give up to a clearing firm. And once that's in, that's the transaction done. It's then going to be a question of saying a very, very simple calculation. What's my freight cost plus what's my futures profit or loss? That's your hedge result. Because if freight market goes up, you're making money on that futures contract. You're spending more in the physical market because the cost has gone up and the benchmark should reflect that. Likewise, if the market has gone down, you're paying on futures, but you're also achieving a lower spot freight price in costs from the ocean liners. That's the simple calculation you have to take when you start this kind of thing off.
If I can then just also jump in with, this is a question that actually I've been posed by a number of people, I'll say, over the last especially 3 or 4 months. The question, well, what if I don't pay exactly the spot rate? And what I think is important to get out here is when you do an index-linked contract, you don't have to pay the index. I mean, there are plenty of index-linked contracts where, sure, the index moves in sync with what your rate is, but you might have a contract that says you pay index minus $200, or you pay index plus $50, or whatever that offset is. So, and that goes both for the index-linked contract. It also goes for the futures contracts. It doesn't mean you have to pay exactly what that index says. All shippers are perfectly capable of then achieving a number that is offset either above or below. But I think, at least I come across it as a somewhat common misconception that you have to pay exactly what that spot contract say, or what that futures contract say, where you can certainly have an offset.
Yeah, I'm with you, Lars. I've definitely gotten that question before. Well, so there's a lot to talk about with this, and I think we've only scratched the surface. So Peter, if you're okay with it, I think we might want to have you on maybe some other episodes to have the proper time to dig into this. A lot of people are not necessarily even involved in the financial world of things, so it's brand spanking new. So let's pause there, and then based on questions that our listeners send in, we can definitely tailor the upcoming episodes to what still needs to be addressed. If you're still confused on the basics, we'll try to break it down in a different way. But yeah, I think this was an awesome episode. Thanks, Peter, for joining us. And for everyone who is still listening, we appreciate you. We'll be back next Monday with another episode. And until then, I hope everyone has a fantastic week. Bye, y'all.
Thanks for listening to the Supply Chain Secrets podcast, presented by NVOCCs. Be sure to subscribe on your favorite podcast app.